And Nigeria's National Bureau of Statistics is scheduled to release its November inflation figures next week. The numbers will be closely watched by economists. Earlier in October, higher food prices pushed up annual inflation in the country. Analysts attribute this to the borders closure. Nigeria also closed parts of its borders in August to fight smuggling of rice and other goods. Annual inflation was 11.61% in October, up from 11.24% in September. Joining me to discuss what to expect from the November inflation and the outlook for commodity prices is an analyst from financial derivatives, Temitope Olugbile. Temitope, it's good to have you with us.
Thank you for having me. Good morning.
So let's look at Nigeria's inflation figures. Annual inflation, 11.61% in October. So what are your impressions ahead of soon-to-be-released November forecast?
Okay, so like you rightly said, November figures will be released next week, Tuesday. And over at FDC, we're projecting that inflation will increase to 11.88%. So that's like 27 basis points higher than what it was in October. And if our projections are correct, it will be the fourth time that inflation is increasing in the last 6 months. And it will bring average inflation so far in 2019 to 11.34%. And, you know, I believe by now everybody's aware of the impact that border closure is having on, you know, commodity prices, and that is still persisting, seeing as we don't know when this border closure, how long it will last for. We don't know when it will be reopened. But one factor that we need to discuss also is the decline in interest rates. So the last primary market auction was held this week, and we saw that 91-day T-bills rates declined to a low of 5%. And now economic theory suggests that you do two things with your income. You either consume it or you save it. And with interest rates, when there's no incentive right now for me to want to save my money, because I'm seeing that T-bills rates, the yields I'll get on a 91-day T-bills rate is 5%. So that is coming from what, 15% at the start of this year. So that is, there's no incentive for me to want to save in the T-bills market. In the OMO market, you've restricted me as a retail investor from saving, from playing in that market. So there's no incentive right now. So and even if you look at the other investment outlets, you look at stock markets is not really the best it can be. We look at real estate, we still see that vacancy factors are at a high. So there's no, those are other investment outlets that you can say, okay, I can save my money there, but there's no incentive right now. So you would want to consume your income. And with that comes increased demand, and with that comes increased commodity prices. So that is one of the key factors we think is one of the determining factors for November inflation figures, and that is also coupled with the effect of border closure. So that is our forecast.
Indeed, and in another angle, in the face of our dwindling external reserves, how would you rate efforts in terms of managing the scenario we are right now with regards to inflation?
Okay, so in terms of our external reserves, I think will play more into our exchange rates. Okay. So if as an investor you're keeping your eyes peeled on external reserves, you're seeing that we are now at $39.4 billion, and we could close the year at $38 billion. You're seeing all of that, and you're seeing the impact of what it can have on exchange rate management, and basically you start to get worried. You start to be spooked by the decline, persistent decline in external reserves, and you would want to take your money, to other outlets overseas. And seeing as the U.S. Fed didn't cut rates further at its last meeting this year, they maintained status quo, and the forward guidance is also that status quo will be maintained. So you might want to, take your money to the U.S. That could be an option. But I think that external reserves plays more into exchange rates and the impact it will have on exchange rate weakness as we go into 2020.
Very good. Do you think Moody's current forecast of Nigeria, from stability to being stable to negative, also took into consideration the current scenario with our inflation scenario by giving out its, verdict, as it were?
Yeah, so that also is another factor that could spook investors. It's we've gone from, the Giant of Africa has gone from a stable to a negative outlook. And what are the factors? It comes down to our fiscal position, our delicate fiscal position. It comes down to the revenues and how there's the outlook for revenue in 2020 is bleak, and and this is even despite the government's effort to VAT increase, to do all it can to boost its revenue, but still Moody's does not believe that it's enough, and that's why we've been downgraded to a negative outlook. So I think that also would, if I'm an investor, I'm a foreign investor, I would be spooked by that. And this is even the fact that you've given me a free pass to play in the OMO markets against your domestic investors. And hedge funds are not, they're hot money. They're called hot money for a reason. It's here today and it's gone tomorrow. So it's, all of that could put pressure on your Naira as we go into 2020. And that could have an impact on your economy. And
to a large extent, they just try telling us to do more, as it were. You know. So let's talk about the oil sector, as it were. So the current narratives here, how would you interpret the figures so far? Brent is up by 0.70% to $64, 65 cents per barrel. So what are your thoughts there?
Yeah, so if we look at oil now, we're at approximately $65 per barrel. And that is just because of what we saw happen yesterday into today. You know, how the US-China trade talks are seeming like it's reaching an end, you know, and coming from the fact that it's President Trump that, you know, causing all the uncertainties. And to see him tweet that, you know, a deal is about to be signed, is coming soon, the market has really gone over the roof about it. And we've seen that, you know, commodities such as oil has reacted to it. And this is, going into 2020, this is good news because even last week we saw that OPEC dipping production cuts, so that already was, you know, giving us signs of an increase in average oil price in 2020. And even since the meeting, we've seen that Goldman Sachs has increased its forecast to 63, and even the EIA has also increased its forecast. You know, so that is good news. So going into 2020, I think the fears of a supply glut, which was coming from, you know, what the OPEC would do and, you know, a reduced demand because of the trade tensions, I think those fears are now going to be ebbed, and we're going to see oil prices do pretty decent.
Indeed. I'm still going to take you back to the US-China angle, to this upward movement of the price, as it were. So can this be sustained, or is it just a fluke on the current narratives?
So I think that so far, I would say that it would really depend on China's response, because as of right now, we haven't heard anything from the Chinese side of things, you know. And yes, what has really made markets enthusiastic was because the person that was causing the uncertainties in the first place is looking like he's, you know, reducing the concerns. But it's a two-sided war, so we need the two sides to agree on it. So we need, I think, what would determine whether it's a fluke or it's sustainable will be China's response. And I think that, you know, they should respond soon. Hopefully they should respond soon, and we hope that it will be a positive response. And just imagine what the markets will react to if both parties, you know, if both parties agree and they come to the markets, will be very happy about that.
Of course, the issue is causing a reverberating effect on global markets, as it were. So let's go to commodities now. Looking at the domestic segment, how are things shaping up there?
Okay, so if we look at the four commodities we track, we track wheat, corn, sugar, and cocoa. We're seeing 3 reds and 1 green. So we're seeing that wheat and cocoa, earlier at the start of this week, we're seeing that the U.S. Department of Agriculture released its 2020 outlook, and we saw that for wheat and corn, we saw they are projecting a stable, you know, output. And, you know, now I think even beyond the oil markets, the soft commodities too are reacting to the U.S.-China trade talks. And because the talk on the market is that the U.S. has agreed to, first of all, suspend the December 15 fresh round of tariffs, and then now they now cut back the existing tariffs by as much as 50%. And so, and that is, there's a caveat to that. If China, you know, demands and purchases high volumes of U.S. agri-commodities, and China is a huge buyer of U.S. agri-commodities like wheat and corn. So that is, you know, that is, the market reaction is now there's prospect of an increase in demand from China for these commodities, and so that is increasing prices. Obviously, because we import these commodities, that is bad news for us because our import bill could skyrocket. But that is what we're seeing now. And now to the side of cocoa, we're seeing that the Ivory Coast, a major supplier of this commodity, is currently experiencing dry season. So we're seeing that is, you know, reducing the supply from this for this commodity. But so far, cocoa prices are declining between yesterday to today. So that we are not really sure why that is. That is despite, you know, reduced supply from Ivory Coast. So that could turn any minute from now, as in cocoa prices could increase, and that is good for us for our export revenue.
Yeah, but you did mention the fact that we still import a large volume of these commodities, as you've just mentioned. So Any thoughts on how consumer purchasing will be affected ahead of the festive season with regards to these commodities and others within that segment as well, domestically?
Okay, so with regards to global commodities, the wheat and corn, they're like, we import these commodities. And so if these commodities are increasing, the first thing it will play on is imported inflation. Because, some local commodities that we consume here, they're dependent on these, the prices of these imports. So they would definitely play into our imported inflation. And that is, if China now responds with a positive response and we see those prices increase further because of increased demand from this country that was once banned from consuming these commodities, we are going to see it play out in imported inflation. And even as like we mentioned at the start of this, inflation is we're already projecting a 27 basis points higher increase in inflation. So that is bad news for the consumers we go into the festive season. And seeing as some states are already looking to pay minimum wage, and that will play into demand again, further increase interest rates, inflation, and then with the VAT increase expected in 2020. So all of these are just negative, is constituting a negative outlook for inflation in 2020.
But briefly, in about a minute, why aren't we stepping up production of these commodities instead of just encouraging the import, as it were? What are the challenges?
Okay, so I think the government is actually doing, we cannot deny its efforts in increasing domestic production. We've seen, an increase in financing to, boost the production of some commodities. But I think more must be done in terms of just infrastructure, enabling business environments, where when you have things like, the strike leading to a blackout, and that is definitely going to affect productivity, irrespective of, the infrastructure they have on ground. So the more needs to be done in terms of infrastructure and the business environment.
Very good. Temitope Olugbile, Financial Derivatives, I'd like to thank you very much for your thoughts on those issues. Always a pleasure to have you.